In this on-demand video, OJM Group partner Jason Odell discusses an attractive feature of permanent life insurance that can offer flexibility and cost savings for the policy owner. If you have more questions or want to learn how to incorporate life insurance into your financial strategy, click the link below to schedule a complimentary one-on-one consultation with one of our experienced team members.
Today we're going to talk about refinancing, restructuring your permanent life insurance policy. We do know that in the mortgage industry, when rates go down, most people will at least examine or refinance their home mortgage. This is a commonplace, happens all of the time. Homeowners will do this, and the savings over a long period of time is significant if they can lower their interest rate by refinancing it. However, it's less likely to be applied to a cost reduction strategy in cash value life insurance or permanent life insurance. And today we're going to talk about why refinancing, restructuring your permanent life insurance may be advantageous. Life insurance and real estate have special sections in the Internal Revenue Code that allow them to make a tax-free like-kind exchange. Most people are familiar with the real estate code section of 1031, and not many people are familiar with the life insurance section, which is 1035. Again, both sections allow for tax-free like-kind exchanges, so moving from one piece of real estate to another, or moving from one permanent cash value life insurance policy to another. Both real estate and cash value life insurance have inherent ongoing costs associated with them, whether that's the interest cost of a mortgage for real estate or mortality expense and cost of insurance charges, also known as COIs, for life insurance companies and policies. These costs are charged over time, and the key is to monitor them and position yourself advantageously if the market changes to benefit you. There are 7 reasons to look at refinancing, exchanging a cash value or permanent life insurance policies. The 7 of them listed on your screen here. We will talk about each of them in detail. First is an industry-wide cost of insurance reduction. What we've seen in the industry over the last 10 to 20 years is that people are living longer. Advances in medicine and technology have allowed for this to happen, and insurance companies have reduced their cost of insurance charges, making today's policies less costly than years past policy. This is one reason why you should at least review and consider potentially exchanging or refinancing your current permanent policy. Another reason is if you're in great health still. If you can still qualify for a top underwriting classification, you will more often than not gain by exchanging to a new policy and getting into a lower cost of insurance structure that would be available to you. Cost structures between companies is another reason to consider refinancing. This is additional charges and expenses that insurance companies charge outside of cost of insurance charges. Each of these are different, each carriers vary, and therefore reviewing and analyzing your existing permanent policy with what else is out there with other carriers and other products and the expenses that they're charging, you may be able to find some significant long-term savings cost as well. Moving to policies with lower access costs. Access costs, also known as the ability to access the cash value in the policies. If part of the strategy when you bought the permanent life insurance policy was to take distributions from it at some point in the future, whether that's early retirement or during retirement, accessing that cash, there's a charge to do that. And each insurance company has a different charge structure. So it's important to understand what is the charge structure and what are other options. We have carriers that charge 8% interest all the way down to 0.25% interest. So it's important to understand what interest rate charges are going on when you access the cash value, if that was part of the structure when you set up the life insurance policy. Moving to a mutual insurance company from a stock company is another reason you might want to look at restructuring or refinancing your policy. Mutual insurance companies are owned by the policyholders, whereas stock insurance companies are owned by shareholders. Obviously, stock companies are beholden to their shareholders in driving value and return to them, whereas with a mutual company, if there's a profitability in the company, they can return that profitability back to the policyholders in the form of reductions and dividends. Therefore, again, mutual companies may be better off than stock companies over time. Taking advantage of new product features. This is something that's very important now. Products that were structured and built 20 years ago don't have some of the enhancements that products that are out there today and built today have, like long-term care riders or distribution riders. And therefore, it might be extremely beneficial for you to look at restructuring it to take advantage of some of the new riders that are available. The final reason that we've listed here is moving from a bond dividend-based whole life policy to one with some stock market exposure. This chart to the right of here shows it comparing a risk-adjusted return with dividend stocks versus long-term bonds. And you can see dividend stocks in the black and long-term government bonds in the green color. Dividend stocks have outperformed significantly over a 1, 3, 5, and 10-year period of time. Therefore, moving to a product that has equity or stock market exposure or a combination of bond and equity stock market exposure might give you a better yield over time, potentially. And clients may look for improved performance to mean improved cash value and better distributions at the time they want to take money from the policy, if that is part of their strategy. So we ran a case study for Bert, and we looked at Bert, who was a 40-year-old individual who purchased a whole life policy from a well-known carrier. Today, he is now 52, and he's curious about whether or not it makes sense to restructure or refinance this policy. While his current company is a very solid one, and so is their whole life product, it's also known in the industry to have relatively high expense charges. When Bert purchased the whole life policy, he was a super preferred individual, and he has still maintained excellent health. We modeled several scenarios for Bert. What we said is if he were to do a 1035 exchange of his whole life insurance policy to a universal life insurance policy with another top-rated company, he would enjoy significantly improved performance through this restructuring refinancing. For Bert, 52-year-old preferred risk, assuming a 5.85% rate of return for each policies, the results are dramatic. Distributions from the whole life product are projected to be $53,696 starting at his age 65 for 20 years. With the same exact assumptions, the distributions from the new universal life policy would be $98,476 for that same 20-year period of time. This is nearly a $45,000 annual improvement and nearly $900,000 of increased distributions over that 20-year period of time. The dramatic improvement in these is really due to probably two things. Likely improved cost of insurance, expenses associated with the move from the whole life product to the universal life product, but also improved costs in accessing the cash values in the universal life policy versus the whole life. For anyone who owns a permanent cash value life insurance product, you should at least have it reviewed and consider, does it make sense to refinance, restructure it in a more efficient way? And it should be a high priority on your list. We encourage you to examine your options. As demonstrated by the case study and the preceding information, moving forward with a 1035 exchange is a complex decision that will be dictated by your specific circumstances. An exchange may not make sense for everyone. It is imperative that you meet with and review closely with a knowledgeable advisor before making any decisions regarding your life insurance. Thanks for watching.
OJM is a multidisciplinary wealth management firm. For nearly 2 decades, our firm has helped physicians across the U.S. reduce taxes, protect assets, and achieve their financial goals. OJM Group offers viewers a complimentary consultation where we can answer your questions to see if our firm might be a good fit for your situation. Simply click the button below to schedule your free consultation. We hope to speak with you soon. Thanks for watching.